March 26, 2025, will forever be etched in the annals of financial history as Tariff Tuesday. President Trump announced a hefty 25% tariff on all imported cars and auto parts. The news sent shockwaves through Wall Street, wiping billions off the market capitalization of companies big and small. The Dow Jones Industrial Average plummeted by 130 points, while the tech-heavy Nasdaq took a nosedive, shedding 2% of its value. Traders scrambled to make sense of the announcement, while CEOs across industries braced for impact. Tech giants, heavily reliant on global supply chains and international markets, found themselves caught in the crossfire. As the dust settled, one question loomed large. Would this be the start of a new era of protectionism, or was it just another Trumpian power play? Tesla, the poster child of electric vehicles and a Wall Street darling, felt the heat immediately. Despite its American roots and domestic manufacturing base, Tesla's success is deeply intertwined with the global supply chain. From lithium sourced in South America to components manufactured in China, Tesla's vehicles are a testament to the interconnectedness of the modern economy. The company's stock plunged 6% on the news of the tariffs, a clear sign of investor anxiety. Analysts warned that the tariffs could increase production costs for Tesla, squeezing its already tight margins. Elon Musk, Tesla's outspoken CEO, took to Twitter, his preferred platform for pronouncements, to express his displeasure. "This is economic suicide," he declared, arguing that the tariffs would harm American businesses and consumers more than they would help. But Musk's pleas seemed to fall on deaf ears as the Trump administration doubled down on its protectionist stance. The company's future, and indeed the future of the electric vehicle revolution, seemed to hinge on the outcome of this high-stakes trade war. Nvidia, a leading manufacturer of graphics processing units that power everything from gaming computers to artificial intelligence, found itself facing a double whammy. The global chip shortage had already strained its supply chains and squeezed its profit margins. Now the auto tariffs threatened to exacerbate the situation, adding fuel to the fire. Nvidia's GPUs rely on a complex web of suppliers and manufacturers spread across the globe. The tariffs, even though directly targeting the auto industry, were bound to disrupt this delicate ecosystem, driving up costs for Nvidia and its customers. The stock market responded swiftly, with Nvidia's shares tumbling 6% on Tariff Tuesday. For Nvidia, the tariffs were a stark reminder of the vulnerabilities of a globalized supply chain. While Tesla and Nvidia grappled with the direct fallout of the auto tariffs, tech giants like Meta and Amazon found themselves grappling with the collateral damage. Though not directly involved in the auto industry, these companies were intricately linked to the broader economy, and thus vulnerable to the ripple effects of the tariffs. Meta, the parent company of Facebook and Instagram, relies heavily on advertising revenue, which is directly tied to consumer spending. The tariffs, by raising prices for cars and other goods, threaten to dampen consumer confidence in spending, potentially leading to reduced advertising budgets. Amazon, the e-commerce behemoth, faced a different set of challenges. The tariffs threatened to increase logistics costs for the company, as higher prices for imported goods and potential retaliatory tariffs from trading partners could disrupt its intricate global supply chain. The stock market reflected these concerns, with Meta and Amazon shares dipping by 2% each on Tariff Tuesday. For Meta and Amazon, the tariffs were a stark reminder that in a globalized world, no company is an island. The auto industry, the epicenter of the tariff storm, braced for a direct hit. With nearly half of all vehicles sold in the United States being imported, and a significant portion of parts in American-made cars coming from abroad, the industry found itself on the front lines of a trade war. Analysts predicted that the tariffs could increase car prices by thousands of dollars, making new vehicles unaffordable for many Americans. This, in turn, could lead to a decline in car sales, forcing automakers to cut production and potentially lay off workers. The response from the industry was swift and unambiguous. The Alliance for Automotive Innovation, a trade group representing major automakers, condemned the tariffs, warning that they would harm American consumers and weaken the U.S. auto industry. As the industry grappled with the fallout of the tariffs, one question remained. Would the attempt to protect American jobs end up hurting the very workers it was intended to help? Tariff Tuesday sent a wave of uncertainty through the financial markets, with market strategists and economists scrambling to assess the potential impact of the auto tariffs. Barclays, a leading global financial services provider, lowered its S&P 500 target for 2025, citing the tariffs as a major source of economic uncertainty. The tariffs introduce a significant risk factor into the economic outlook, said a Barclays analyst. They have the potential to disrupt global supply chains, fuel inflation, and dampen consumer confidence, all of which could weigh on economic growth. The Federal Reserve, already grappling with rising inflation, found itself in a precarious position. The tariffs threatened to exacerbate inflation, potentially forcing the Fed to raise interest rates more aggressively than planned, which could stifle economic growth. Investors, spooked by the prospect of a trade war and its ripple effects, adopted a cautious approach, holding back on investments and seeking safe haven assets. The auto tariffs, beyond their immediate economic impact, raised broader questions about the future of globalization and the rules-based trading order that had underpinned global prosperity for decades. The tariffs were seen by many as a sign of America's retreat from its role as a champion of free trade, a retreat that could have far-reaching consequences. The European Union, a key trading partner of the United States, threatened retaliatory tariffs, raising the specter of a tit-for-tat trade war that could escalate quickly. China, already embroiled in a trade dispute with the United States, condemned the auto tariffs, warning that they would harm the global economy. The tariffs signaled a shift in the global trade landscape away from multilateralism and towards a more protectionist, inward-looking approach. The world was watching to see whether the United States, once a champion of free trade, would retreat further into protectionism, or whether it would reaffirm its commitment to a rules-based trading order. As the dust settled on Tariff Tuesday, one question loomed large. Would the tariff gamble pay off? Would the tariffs achieve their stated goal of reviving American manufacturing and protecting American jobs? Or would they backfire, hurting the very people they were intended to help? The tariffs had the potential to create some manufacturing jobs in the short term, but they also had the potential to destroy jobs in other sectors of the economy, such as retail and transportation. Furthermore, the tariffs could lead to higher prices for consumers, negating any wage gains made by workers. The long-term impact of the tariffs was even more uncertain. The tariffs could lead to a decline in innovation as American companies, shielded from foreign competition, become complacent. Only time would tell whether the gamble would pay off, or whether it would leave the American economy and the global trading order worse off.